Hello and welcome to the Wake Up Call podcast. Today we are speaking with Mr. Paul Martin Foss about the Federal Reserve, how it operates, and the tools and policy options it attempts to use. Mr. Foss is the founder, president, and executive director of the Carl Menger Center for the Study of Money and Banking. He previously worked for 6 years as legislative assistant for monetary policy and financial services in Congressman Ron Paul's office, and 1 year as deputy legislative director for Congressman Thomas Massie. You can follow his work at mengercenter.org. You can find him on Facebook under Menger Center and on Twitter at Menger Center. That's at MENGER Center. For more information, please see the show notes page for this episode at wakeupcallpodcast.com/federal-reserve. Paul Martin, welcome to the show.
Thank you, Adam. Thank you for having me.
Well, thank you for joining me. So let's get started with a couple of basic definitions. So what is a central bank? And then a very brief overview of what is the Federal Reserve.
So the central bank would be the government-appointed kind of lender of last resort. That's one of its functions. In many cases, it's also the issuer of the monopoly currency. That is the only currency within a certain country that's allowed to be issued as legal tender and used as legal tender. Central banks were created to kind of create a centralized banking system and a banking cartel that would easily provide funding to governments to enable them to do their business, especially to fight wars and to expand their operations. The Federal Reserve is the U.S. central bank. It was created to be kind of a quasi-decentralized central bank because there was a lot of opposition to central banking in the United States in the early part of the 20th century. So they came up with the idea of having, it's kind of a public-private partnership where you've got the public aspect, which is the government agency. The Federal Reserve Board sits in Washington, D.C., and the Board of Governors is appointed by the president, and that's a government agency. And then you have the 12 Federal Reserve banks, the regional Federal Reserve banks, which are they have government charters, but they're technically private organizations. And the FOMC, the Federal Open Market Committee, that's the part of the Federal Reserve that sets the monetary policy directives that targets the federal funds rate. They're a combination of 7 of the Board of Governors of the Federal Reserve Board, and then 5 of the regional reserve bank presidents. And it was intended to have kind of this facade of decentralization, but giving so much power to the Federal Reserve Board of Governors, it was clear that the people who founded the Federal Reserve wanted to make sure that all the decisions were made in Washington by the political appointees.
All right, so we'll return to the structure of the Federal Reserve in a bit. But can you talk about how and why the Federal Reserve came to exist and why the Federal Reserve and central banking are such important issues? Yeah,
I mean, the kind of the short-term impetus, or I guess it was maybe a longer-term impetus, was to end financial panics. The proximate cause was the Panic of 1907, which was one of the largest financial panics the U.S. had seen. And the people who founded the Federal Reserve said, well, okay, we want to finally put an end to financial panics. There were periodic currency crises, and banks would fail. There'd be bank runs. And they said, well, this isn't a good thing, so we'll put together this National Monetary Commission. We'll study other countries, what they've done, study their central banks, and we'll try to create a system that will ensure that we have, as they put it, an elastic currency that will prevent financial panics and currency crises in the future. It didn't obviously work out that way because really the purpose of central banks is to provide an elastic currency or a growing currency, an increased monetary supply for the benefit of the government. Central banks throughout the world basically buy up a lot of government debt. They monetize the debt, if not directly, then at least indirectly. And they enable government to spend beyond its means. They enable a whole bunch of unnecessary military spending on warfare, spending on domestic boondoggles, infrastructure, wasteful infrastructure projects, welfare spending, etc. The reason that central banking is so important and people need to take notice of it is that the central banks and their monetary policies do allow a lot of government overreach. And if they're not reined in, or if they go off the rails, or if they're captured by politicians like we see in Zimbabwe, Venezuela, a whole bunch of other countries that have had hyperinflationary crises, they will eventually destroy the monetary unit, and society just comes, crumbling down, and you end up having rioting and food shortages, and society just completely breaks down until the central bank is booted out and things can start up again.
All right. Now, earlier you briefly mentioned that the Federal Reserve is a public-private partnership. Can you elaborate a little bit more on what that means and what the implications are of that arrangement?
Yeah, I mean, it's a very bizarre arrangement in the fact that you do have the Federal Reserve Board, which is a government agency, and then you have the government-chartered private organizations, which are the Federal Reserve banks. They're in terms of their privacy or their existence as a private organization, they'd be kind of equivalent to Fannie Mae and Freddie Mac in that they are technically private but government-chartered. But the Federal Reserve banks also, their board of directors is who selects the Federal Reserve Bank president, and you have 9 members of each board of directors in each Federal Reserve Bank. 3 are appointed by the banks, 3 are appointed by the Federal Reserve Board in Washington, and then 3 are supposed to be representative of community or agricultural interests or other non-banking interests, but they're also appointed by the Federal Reserve Board, or have to be approved by the Federal Reserve Board, I believe. So there's still a lot of input from Washington, a lot of influence that Washington has over who exactly becomes the president of each regional Federal Reserve Bank. The real significance of the fact that you have this public-private partnership is that the Federal Reserve Board, being a government agency, is required to comply with Federal Freedom of Information Act requests, FOIA. The Federal Reserve banks, the regional Federal Reserve banks, are not subject to FOIA. So there's a lot of stuff that, I mean, if you want to figure out or find out some of the things that your regional Federal Reserve Bank is doing, you're not going to be able to file a FOIA request because it's a private organization.
Wow, that's interesting. Now, you keep mentioning these regional banks. You mentioned the Federal Open Market Committee. Can you go over sort of the general structure in a little more detail and explain what role each of these plays and why there are these regional banks and then, I guess, even sub-regional banks?
Yeah, I mean, the regional banks were originally created because, well, they wanted to make sure that you had kind of this quasi-decentralized system, but you had to adequately represent each area of the country. And so they created 12 Federal Reserve districts, and they wanted to make sure that New York, had the biggest role, was the most important bank. So the president of the New York Fed actually has a permanent seat on the Federal Open Market Committee. New York is the first among equals, essentially, and that ensures that New York's views are always, and Wall Street's views, therefore, are always present in Washington when monetary policy is being made. The other Federal Reserve banks, I mean, again, it was, intended to represent the country, but populations have shifted and changed, and now you have huge swaths of the West that are just represented by the San Francisco Fed. It's still very heavily geared towards the East Coast financial establishment and Wall Street, and so that's why you have these, this definite Wall Street bias on the Federal Open Market Committee. The Federal Open Market Committee, as I said before, it's composed of the 7 members of the Board of Governors, 5 of the regional bank presidents. The New York Fed has a permanent position. All the others rotate in basically about every 3 years or so. They will rotate in to become voting members. And the FOMC is actually the body that sets the target federal funds rate. They meet every 6 weeks, and they set the federal funds rate target, which is the rate at which banks can borrow amongst themselves from balances that they hold at their regional Federal Reserve banks. So if a bank at the end of the day is finding itself a little short of cash and needs to get some money, borrow some money to cover checks that are clearing or for whatever reason, they can borrow from the reserve balances that another bank has at the Federal Reserve, regional Federal Reserve Bank, and the interest rate they pay is the overnight rate, which is the federal funds rate. And so that rate is targeted by the Fed, and they do that through buying and selling of bonds and other assets. So they're actively involved in the U.S. Treasury bond market, mortgage-backed securities markets, et cetera, to influence and push that target rate either up or down as they decide what to set it at.
And how does Janet Yellen and her predecessors, and I guess her successors when they come, but how does the chairman or chairwoman of the Fed fit into this overall system?
Well, basically the chairman is appointed by the president to a 14-year term or 4-year term as chairman. 14 years is the term of the Federal Reserve governors, but it's a 4-year term as chairman. And the chairman basically, even though it's not explicitly stated, does the will of the president. So if the president wants a looser monetary policy because he wants his party to do well in the fall elections, he will put some pressure on Janet Yellen or her successors. Hey, let's push the funds rate down a little bit. Let's boost the economy, heat things up, get asset prices and house prices moving, make people feel richer, make them feel good about themselves, and then maybe they'll vote for my political party. That's kind of the intent of it. But the chairman ends up being, they're not really a dictator, but there's never been an FOMC meeting in which majority of members have outvoted the chairman. The chairman basically sets the direction of monetary policy, and whatever his or her recommendations are, that's pretty much what's going to happen, and nobody's going to vote them down.
And you mentioned that the chairman is appointed by the president. Which Federal Reserve officials are appointed by the president? And for those who are not appointed by the president, how do they come to hold their positions?
So the board of all the members of the Board of Governors, the 7 members of the Board of Governors, are appointed by the president, and they have to be confirmed by the Senate. We actually have there's two open slots right now because the Senate has not wanted to take up any of the appointments that President Obama has made, and so we've got 2 open seats. So it ends up being a 5-5 split now. There's only 10 members on the FOMC rather than 12. The Federal Reserve Bank presidents don't have to be confirmed by the Senate or appointed by the president. They are, again, that 9-member board of directors is who selects the president, and it's 3 people from the banking industry, 3 from who were appointed by the Federal Reserve Board, and then 3 who are supposed to represent general business interests and popular interests in their particular Federal Reserve district.
Okay, so let's talk about these Federal Reserve districts and regional banks and sub-regional banks a little more. So I'm here in Houston, and there is a branch of the Federal Reserve Bank of Dallas in Houston. What role is played by that branch in Houston and by similar branches across the country, and how does that compare to what takes place in Dallas and at the other 11 regional facilities?
So in each region, and especially in the West, because they're so large, they will have a lot of sub-regional facilities. I think San Francisco has one in L.A. They've got them all throughout the West, and so you have these other cities where you'll have a smaller branch, but it's still staffed with a whole bunch of economists and officials. A lot of the stuff that they do there, the Federal Reserve is involved in. They run a huge check clearinghouse. So, a lot of processing of checks that are written and taken in for payment by banks is done in those regional facilities. A lot of bank supervision is done. I'm sure Houston has some major banks with operations. I'm sure probably Wells Fargo or Bank of America has buildings or operations there. So there would be bank supervisors that might be based in Houston to oversee kind of the operations of the banks doing business there. They do can be a lot of economic research at some of these sub-facilities. You may have some research economists who are just there writing papers, and they do a lot of outreach to the community because the Fed, as any other government agency, likes to kind of propagandize on behalf of what it's doing, and so they'll often at these regional branches host the president of the regional bank for an evening and invite community leaders and teachers to come in. They'll hold seminars for teachers and say, here you can come in and learn about what the Federal Reserve is doing, and we'll provide you with materials to take back to your students and teach them about how wonderful the Fed is and how wonderful easy money is and how how great things are being made by the Fed. So there's a lot of that type of stuff going on too.
All right, now one issue related to the Fed that became a bit of a controversy not too long ago was the gold being held at the New York Fed. Some of the foreign countries' gold that was placed there, particularly Germany. So when we talk about gold being held by the Fed, why and how does the Fed come to hold this gold, and what significance does that mean that the Fed holds this gold?
Well, a lot of the gold that was held there was placed there by countries during World War II. At least to my understanding, they would ship it out of London or ship it out of Paris or ship it out of their various countries and take it to the U.S. for safekeeping. The New York Fed has this gold vault that's buried kind of in the bedrock of the island of Manhattan. I know a lot of Germany's gold was put there during the Cold War to protect it in case of a Soviet invasion, because it's reputed to be such a secure facility. A lot of smaller countries, and their central banks decide to put their assets there in New York. And I've actually been in the gold vault. We took a tour with Financial Services Committee staffers, and they gave us the inside tour and showed us all the various vaults. There's nothing labeled as to who exactly holds all the ownership of the gold is, but you can tell a lot of it is American. I think about, I'm trying to remember, I want to say it's something like 90 million ounces. It's about 40% or so of the United States gold holdings, U.S. government's gold holdings are at New York, at the New York Fed. One of the main significances is that because you have all these countries, dozens of countries who have all their gold there, it facilitates swaps of gold among countries. Because it's also in New York, which is a huge financial capital, a lot of these countries will also engage in swaps and gold loans to the markets. And they'll, if they need some extra cash, they'll sell some gold, and it might come straight out of the New York Fed's vault and go straight to, J.P. Morgan or some other bank, or it'll get sold, in the New York markets, can be loaned out there. There have been a lot of allegations that there have been government attempts to drive down the price of gold through gold swaps or gold loans that are not reported and not required to be reported by the Fed. And so we really don't know, what and they won't tell you what happens to a lot of that gold. I remember Venezuela repatriated its gold a couple of years ago. And when we were at the New York Fed, they said, yeah, we had a customer who repatriated some of their gold last year, about so and so many tons. And I said, oh, was that Venezuela? And he said, well, we're not allowed to say who exactly the customer was. So, they keep their lips sealed. All the stuff that goes on with that gold, who's trading with whom and who's loaning it to whom, nobody knows anything about. And again, because the New York Fed is a private institution and not a government agency, if you were to try to submit a FOIA request to find out, okay, what exactly is that gold being used for? Is it being used to manipulate the gold price on markets? You wouldn't be able to get any information out of them.
Do we have any idea if the Fed actually has as much gold as they claim to have?
Well, I've been in the gold vaults, and I've seen a fair amount of what's in there. And some of those vaults were pretty darn full. I don't know what 90 million or 150 million or 200 million gold ounces would look like in bar form, and exactly how much space it would take. But I suspect they probably do have most of it. But I don't think we had. I'm trying to remember, because we dealt with this issue in Dr. Paul's office quite a bit with the audits. I don't think that the New York Fed gold holdings, at least the U.S. holdings, had been audited in a very long time. It just seemed to, I don't know if it was intentional or if there was just, nobody had ever thought of it or brought the question up, but they hadn't been doing a terribly good job, I don't think, of ensuring that all the gold that they, were supposed to be holding on the U.S.'s behalf was actually there.
Okay, and one more question about the structure of the Fed before we move on to policy options and processes through which they increase and decrease the money supply and things like that. Mm-hmm. How do commercial banks tie back into this system, and are all commercial banks required to be members of the Fed? How does that whole structure work? Yes,
I believe that I know all national banks are required to be members of the Federal Reserve System. State chartered banks, I believe they're not required to be, but in practice most of them are, because it gives them access to discount window lending, gives them access to the clearinghouse operations. It gives them a lot more advantages than it would be to be outside the Federal Reserve System. And to be part of the Federal Reserve System, you then have to buy a certain number of shares in each Federal Reserve Bank. They all they issue shares, and each member bank is technically considered an owner of that Federal Reserve Bank, and they're given a prorated number of shares based on their ownership stake.
All right, and just to be clear, what's the difference between a national bank and a state chartered bank?
So a national bank is one that has a national charter. They operate in multiple states. They're going to be regulated by Federal Reserve, FDIC. OTS doesn't exist anymore. Office of the Comptroller of the Currency. They're going to have their primary regulator is going to be a federal regulator. The state chartered banks are chartered by a state Department of Financial Services. So if you just wanted to operate within the state of Alabama, you would be a state chartered bank in Alabama, and then the state Department of Financial Services would be your primary regulator.
Okay, so now let's move on to the technical process through which the Fed implements different policy options. So how does the Federal Reserve increase and decrease the money supply? Can you go into that process a little bit?
Yeah, they increase the money supply by purchasing assets through what's called open market operations. They basically go onto the open market and they will purchase Treasury securities or mortgage-backed securities, and then those, that newly created money is basically they just created out of thin air, used to purchase these Treasury securities, and it's then held, on the books of the bank or financial institution from which the Fed bought these securities, and so that's new money that's flowing out into the system that then can be spent on other assets that can be loaned out to other people. And in that case, the money multiplier begins to take effect. So that's how they increase the money supply. To decrease the money supply, they would sell those securities back into the open market. And so they would, say, well, we're going to sell, $5 billion worth of Treasury securities, and they would work with some of the large banks to then have those banks then purchase those Treasury securities and take them off the Fed's books, and that decreases the amount of money in the banking system and shrinks the money supply.
Okay, so what is a primary dealer, and how do primary dealers fit into this system?
Primary dealers are I think it's 19 right now, largest banks. They're both U.S. banks and international banks. The New York Fed creates a list of primary dealers, and those dealers are required to bid. So when the way the U.S. Treasury funds government operations, they'll issue new Treasury debt at an auction, and people will bid, institutions will bid at those auctions for that newly issued Treasury debt. The primary dealers are required to bid at those auctions. So they also get first crack at the new Treasury debt, and they're required to bid at those auctions. So basically, they are cooperating with the New York Fed and the U.S. Treasury to purchase newly issued government debt, so that there will always be a ready market for government debt, and the government is never going to have a failed auction where it can't sell debt and therefore can't fund its operations. So they're basically, colluding with the federal government and the Federal Reserve to ensure that the government will always be able to spend a lot of money.
Okay, and how does this process add to the national debt? Because a lot of times you'll hear this slogan about the national debt that we owe it to ourselves. Now, forgetting about the fact that the we and ourselves oftentimes are not the same groups, how does this overall process of increasing and decreasing the money supply in and of itself add to the national debt totals that we see on TV or online?
Well, the money supply is always increasing. Any decreases are only very temporary. It's, it'd be like taking 2 steps forward and 1 step back, then 2 steps forward and 1 step back. You're always going to be increasing. So any small, decreases in the money supply are only very temporary before they start increasing again. In terms of the national debt, the Fed is basically, and especially through quantitative easing over the past several years, it has greatly increased the amount of Treasury debt that it's purchasing. There was, I think at one point it was something like 90% of all newly issued debt was purchased by the Federal Reserve. And, what they would do is there would be a Treasury auction, the primary dealers would bid and buy, some of this debt, and within 30 minutes they would sell it right back to the Fed. So the Fed would have this newly issued Treasury debt. It wasn't direct monetization, but it was about as direct as it's possible to get in our system without the Fed, buying it directly from Treasury themselves. And basically, the fact that the Fed, the increase in its balance sheet, it went from $800 billion before the crisis. Now it's at about $4.5 trillion. About $2 trillion of that is Treasury debt. So that was a total increase. They'd actually drawn down their Treasury holdings significantly when they were purchasing mortgage-backed securities. So they actually bought something like $1.5 trillion worth of Treasury securities over the course of a couple of years, and that was, basically almost all you had those, $1 trillion deficits. Well, almost all of that debt that was issued to fund those deficits was being purchased by the Fed. So the Fed is directly, through its purchases of Treasury debt, allowing the Treasury to spend more money than it's taking in.
All right, now when we talk about the Fed's balance sheet, what sorts of assets are on that balance sheet?
It's about roughly 50% Treasury securities, 50% mortgage-backed securities. Agency securities, they're Fannie and Freddie, agency securities that are backed by mortgages. There's a small amount of other stuff. Occasionally, you have swap lines that they'll open up with foreign central banks. There's a little small bit of amount of foreign exchange, et cetera. But for the most part, it's all Treasury securities and mortgage-backed securities.
Okay, and are there any limitations to what can and can't go on the Fed's balance sheet?
Yes, there are. I don't know them exactly off the top of my head. I know that they are enumerated in the Federal Reserve Act. What exactly they can and can't buy, but there's a lot that they're able to buy. I mean, traditionally they don't want to buy anything but Treasury debt, because once you start, if you were to start buying, say, General Motors debt or Chrysler or United Airlines or something like that, then you're starting to get into the business of picking winners and losers, and that would, you start buying one company's debt, and another company says, "Oh, that's not fair. You have to buy my debt too," and it just leads to a whole bunch of political problems. So that's why they've stuck to Treasury debt and, as they call it, agency debt, because Fannie and Freddie are, again, kind of public-private entities that have a government guarantee. So they try to stick to stuff that is relatively politically neutral, but that doesn't mean that they have to stay that conservative in the future.
All right. Now, earlier you briefly mentioned the discount rate and the federal funds rate. What are those two figures, and how do they change? We've seen a lot of discussion about potential changes in them in recent months. How do those changes come about?
Yes, the federal funds rate is the overnight rate that banks are able to borrow from themselves from other banks' balances at the Federal Reserve. The discount window rate is the rate at which a bank can come and borrow directly from the Fed itself, and that's higher than the overnight rate because they want to assess a penalty rate to make sure that banks aren't coming to the Fed hat in hand on a regular basis. Those are both, historically super low. I think the Fed discount window rate, I think, is around 3/4 to 1%, and then the overnight rate, the federal funds rate, is at between 1/4 and 0.5%. And it's been this way since about December of 2008, I think, is when they dropped it to 0 to 1/4%, and it stayed that way until last December. So it was 7 years of, and it still is, you look at the effective federal funds rate every day that the New York Fed publishes, right now it's around 0.3%, which is incredibly low. And to keep it that low, you've got to keep pumping money into the system, keep purchasing assets. The Fed's balance sheet keeps increasing and increasing. Money supply keeps increasing. Prices keep increasing. Their intent is to try to kickstart the economy and get things going again, but it's really it's a failed policy. It hasn't done what they wanted it to do. It's not going to do what they want it to do. It's just going to pump more money into the system. It's going to heat up asset prices. It's already, we've got all sorts of bubbles throughout the economy in all sorts of various sectors, and it's all going to end very badly.
All right. So what other policy options does the Fed have, and what policy options do you anticipate them trying in the near future?
Well, they got negative rates. They could always go push rates negative. That's one thing that they've said that's the last resort. But I'm not so sure about that. You've already got negative rates in Japan, Europe, ECB, I think Sweden, Denmark, Switzerland. Got a lot of negative rates there, so it's been done before, and they're keeping their eyes on it. The other thing they could do, there's also the interest on reserves that banks get. That was a new power the Fed got pushed up from 2011 to 2008. They got it in that same bailout bill that bailed out the banking system in 2008. That allows them so banks are required to keep a certain percentage of their deposits as reserves at the Federal Reserve. Anything in excess is considered excess reserves. So it's basically a certain percentage based on the amount of assets you have. You're required to put 10% or 3% or 1% hold it at the Fed. Anything in excess of that is called excess reserves. And traditionally, banks don't keep excess reserves because you want to loan that stuff out and get it working for you, making money. Well, 2008, they decided to give the Fed the power to pay interest on excess reserves. So the interest on excess reserves now is about a 0.25 percentage point above the federal funds rate. So banks basically right now are getting, about 0.5% on all their excess reserves. And in an environment that's still very unstable, in which there are not a lot of great investment opportunities, a lot of banks will just park their excess reserves at the Fed and get the guaranteed 0.5% interest rate, because at least they're making money. Whereas if they were going to loan it out to people and the loans go bad, then they lose money. So that's one of those areas. That's another policy area where the Fed could tinker. One of the reasons I think they started paying that interest on excess reserves and set it at the rate they did is because all this money they were pumping into the system through quantitative easing could have and would have easily led to hyperinflation, super hyperinflation. And so they were intentionally paying this interest rate on excess reserves to soak up a lot of this new money that was being pumped into the system. So they could now start monkeying around with that rate and maybe lowering a little bit to see, okay, if we lower it from 0.5% to 0.4%, will it, how much money is going to start leaving the system, or just take it down just a little bit to try to, so that the Fed doesn't actually have to pump any more money in the system. The stuff that's already there, tied up in reserve balances, can be pushed out. That's another possibility for something that might happen.
And do you think we'll see another round of quantitative easing?
I would not be surprised. I mean, you hear a lot of talk about helicopter money now. I mean, Ben Bernanke was kind of the butt of a lot of jokes when he said, "Oh yeah, we have this weapon called the printing press, and we can just print money and drop it out of helicopters." And people laughed and chuckled and called him Helicopter Ben. But now people are starting to take it seriously, central bankers, because basically every single policy that they've pursued so far has been unsuccessful, and so they're looking to these radical policies that they previously would not have even considered. And so this helicopter money, they would basically just be pushing money out. Who knows how they would actually go about doing it? I mean, they might start buying corporate debt or stocks from stock exchanges. There's a whole bunch of things that they can do. So it's I would not be surprised to start seeing a whole bunch of unconventional monetary policies being undertaken that people previously would not have even considered.
All right, and one other concept I want to ask you about and how it ties back into the Fed is fractional reserve banking. So what is fractional reserve banking, and how does the Fed allow for that process to carry out?
Fractional reserve banking is the practice of only keeping a fraction of your deposits on reserve to cover checks being drawn on people's accounts, or people coming to withdraw money from their bank accounts. The banks very quickly realized that when people were depositing their money, that they weren't making use of all of it, and so they figured, people aren't going to come and ask for their money back, or they're only going to write a certain amount of checks before the next paycheck comes in. So we only have to keep about 50% on reserve, or 20% on reserve, or 10% on reserve. The danger, of course, was that if people all of a sudden wrote some big checks, or if they came to your bank and said, "Oh, we want our money back, and we want to close our account," and you didn't have the money, that you had to say, "Well, I'm sorry, we don't have your money." Then word gets around, people lose confidence in your bank, a bank runs sues, and your bank goes under. And that can lead, if there's a lack of confidence in other banks, it could lead to a systemic banking crisis. So the Federal Reserve, in acting as a lender of last resort, one of the things that it does is, if a bank finds itself in that type of situation where it doesn't have money to cover withdrawals or checks being cashed or things like that, the banks can come to it and say, "Okay, we need this much money. We need it for a certain number of days." And the Fed says, "Okay, we'll loan you this money," and they basically create it out of thin air. It's created out of nothing. But they'll say, "Okay, we'll forward you a loan. We'll print this new money, give it to you, and you pay it back at the end of this term, and hopefully that will bridge your problems and keep your bank from going under." And that's how the Federal Reserve was intended to try to stem bank crises. It didn't really work out that way. There were still a lot of bank failures during the Great Depression that led to the FDIC being created with deposit insurance, and this idea that, well, even if a bank goes under, you're going to get the entirety of your bank deposit back, and it's going to be paid for by this Federal Deposit Insurance Fund. And I think a lot of people don't realize that there's not enough money in the insurance fund to cover all the potential losses if there's a huge banking crisis in the future. So fractional reserve banking is very, very dangerous. I mean, it's inherently risky because you risk going under if you don't have enough money, and you're basically, I mean, this is how the money multiplier works: is you're saying, well, I'm going to take $9. Somebody deposits $10, I take $9, loan it to somebody else, and they'll deposit it, and I'll take $8 and loan it to somebody else, and pretty soon you've taken that first $10 and you've turned it into $100 in loans, and you're just hoping that the first guy who initially deposited $10 doesn't pull it out, because if he does, you've got nothing. You've got this huge, a huge amount of loans and deposits that are created basically on a tiny little pyramid of real money.
All right, so how would you describe the state of the economy right now in the United States, and what solutions do you think should be implemented as far as monetary policy and a potential return to sound money are concerned?
Well, I think the state of the economy is pretty poor. I mean, obviously, we still have a large economy producing a lot of things, but it's not nearly where it could be. I think within the next year or two, we're going to see another financial crisis, another economic crash. The bubble has just been built up too large, way too large this time, for us to be able to escape it. And I think it's going to be worse than 2008. I think in terms of solutions, the biggest solutions are number one, currency competition. The Fed is continues to devalue the dollar. I really think that allowing currency competition, allowing private currencies to compete on the same level as the U.S. dollar would go a long way towards some sort of monetary stability. You have to get rid of a lot of the restrictions on issuance of private currencies, a lot of the so-called anti-counterfeiting laws, the capital gains taxes on gold and silver, legal tender laws, things like that. Basically allow them, private currencies to compete with the Federal Reserve note. And the other thing is to get rid of fractional reserve banking and go to an actual system of free market banking, in which you don't have to, get a government charter to start a bank, in which anybody can enter, and it's basically caveat emptor, in which banks are actually required to take responsibility for their losses and to go under. I mean, most people don't realize and understand that when you deposit money into a bank, that's not being held there for safekeeping. You are essentially loaning your money to the bank for the bank to use for its own purposes of loaning out to other people. So it's essentially an investment. And most people, because of the advent of deposit insurance, most people don't see it as that. They see it as a risk-free deposit. And that's why they are so upset when banks go under and they want their money back, because they see it as something that should be risk-free, and it's not. There's nothing that's risk-free in the financial system. So I think there needs to be a sea change in how people view banks, and that would require that when banks decide to engage in fractional reserve banking, that there is no, if they want to create a private backstop and a private system of lender of last resort where they have clearinghouses like they used to before the Federal Reserve, or if they want to, create a private deposit insurance system, great, let them do that. But if they do that and they still fail, then no bailouts from the government. The depositors get wiped out, the shareholders get wiped out, the bondholders get wiped out. I mean, you really need to treat it as any other business. There's no other. I mean, when your grocery store, fails to sell enough food and can't pay their employees, the government's not there to bail them out. Your car mechanic, when he doesn't have enough business to stay, keep his employees paid, he's going to go under. He's not going to have the government bail him out. The banking system should be exactly the same.
Okay, and a lot of the time you'll hear discussion about auditing or even ending the Fed. What attempts have there been to audit the Fed in the past, and how likely do you think a Fed audit is in the future? And then what do you think about the idea of auditing and or ending the Fed?
Well, I was responsible for audit the Fed legislation in Dr. Paul's office. So I kind of have a soft spot, obviously, for that bill, which is actually, today it's going to be the Oversight and Government Reform Committee is supposed to mark it up on Tuesday, May 17th at 2 p.m., I believe, from what I've heard from the press releases. So it'll be marked up again. But we actually did a historical survey when we were in Dr. Paul's office of previous Federal Reserve audit attempts. And since 1973, I think there had been something like 49 different bills that were introduced by various different people, Democrats, Republicans, a whole bunch of people. Dr. Paul was not the only one, but his has been the one that's gained the most traction. The first time we introduced it got 320 co-sponsors. We initially passed a modified version of it in the first version of what eventually became the Dodd-Frank bill. It got stripped out, unfortunately, in conference on the Senate side, but it passed again the following Congress, and I think the Congress after that as standalone bills. So it's a very popular idea. It's a kind of a common sense idea. I remember when we first got the coalition together to try to pass it, we had the Heritage Foundation, Campaign for Liberty, AARP, and the AFL-CIO all supporting Audit the Fed. It was, they say politics makes for strange bedfellows. It was, basically everybody, all the big organizations on the left, all the big organizations on the right, they all supported the bill. And honestly, it is very important. When GAO first was debating, or when Congress was first debating these audit powers and the restrictions on audits back in the mid to late 70s, GAO, the Government Accountability Office, which is the organization that would be doing these audits, said that we do not think that we can adequately audit the Federal Reserve System unless we have access to monetary. We can view the monetary policy operations, and right now they're not allowed to. That's the largest group of transactions that the Federal Reserve engages in, and GAO is forbidden by law from looking at them. So that you cannot, GAO cannot go in and look and see and make sure there's no shenanigans there. So it's common sense legislation. I'm glad to see it's moving again in the House this year. Unfortunately, the Senate just won't take it up. They can't get any traction there. It's a lot more difficult. But I'm hopeful that if people keep plugging away at it, that eventually there might be some progress there. And then ending the Fed, ideally, Dr. Paul also had an end the Fed bill. That would be very nice to see the Fed ended. But honestly, if you were to really have currency competition, I think the Fed's reason for being would kind of fade away, because private currencies would be able to outcompete the Federal Reserve note, and the Fed would eventually be forced to go out of business, essentially. The alternative is, if nothing happens, they will probably eventually, through their monetary mismanagement, completely destroy the value of the dollar, lead to some sort of inflationary or hyperinflationary crisis, and in that way they would put themselves out of business. They're gonna end somehow. It would be much nicer if we could do it on our own terms and dictate exactly how it's going to be, than have it be the result of their own mismanagement.
And what do you think we could learn from an audit of the Fed, and what would the fallout be from an audit?
Well, I think the major thing is, what exactly is the Fed purchasing? What exactly is behind these mortgage-backed securities? What kind of other assets are backing these securities that they're buying? A lot of it also is what is the Fed doing with foreign countries? They don't have to report anything they do with foreign countries, foreign central banks, foreign governments, the IMF, the Bank for International Settlements. All the agreements they enter into, they're not required to publicize anything. They're not required to publicize their meetings with foreign officials. There's a whole bunch there, whole lot of things that Congress really should have access to. Congress should demand it, but it's just not being done, and the Fed is taking advantage of that and kind of operating in the shadows.
All right, so one final question before we wrap up. How bad do you think the economic situation in the U.S. will get, and are there any reasons to be optimistic?
I think it's going to be, within the next year or two, at least as bad, if not worse, than 2008. The only thing that I would be optimistic about is that there are a lot more people who are waking up, who are realizing what exactly the Federal Reserve is doing, and how it's created this horrendous economy, and how it creates the boom and bust cycle. And I think the more people who wake up, the more people will, put pressure on their congressmen to exercise oversight of the Fed, and I think the more that people will realize that the solutions that are offered, which is always more money printing and more quantitative easing, are failures, and they will, hopefully, as they begin to understand that, become a lot more vocal in opposing these policies, so that in the future, I am optimistic that there will be a lot more opposition to these policies, and we won't see quite as much of this, hopefully, in the future.
All right. Well, thank you very much. Can you talk about the Menger Center a little bit, and who Carl Menger was, and what the best ways are to follow your work?
Right. So the Menger Center, we named it after Carl Menger, who is the founder of the Austrian School of Economics. He was one of the three major economists who led to the marginal revolution in economics. And so we wanted to, kind of mark ourselves as being firmly within the Austrian economics tradition. But Menger also wrote a little book called, a little booklet called On the Origins of Money. He was involved with the Austro-Hungarian Currency Commission that introduced the gold standard in Austria-Hungary. But his little pamphlet on the origins of money, he basically talked about how money is a spontaneous creation of society. It's not something that was created by the government, and that's very important. a lot of people don't realize that. They don't understand the significance of that money is it's a market creation. It spontaneously arose from the interactions of people who wanted to facilitate trade and make trade easier, allow for indirect exchange, which has allowed civilization to flourish, to grow and flourish. It's not some top-down dictate from a bureaucrat or a king or an emperor. It's a very important concept that people need to understand. And so we basically focus on money and banking issues from an Austrian perspective, and trying to educate the American people and teach them more about money and banking issues, to comment on current issues that are going on with the Federal Reserve, Bank of Japan, European Central Bank, within the banking system, and try to comment also on current events, so that when people see these things happening and they hear Janet Yellen or Mario Draghi or Mark Carney or Governor Kuroda from Japan, or they hear these people talking, or they hear news about the banking system or Goldman Sachs, that they can then come to our site and get some commentary and some take on these current events from an Austrian perspective, and begin to understand them, so they're not kind of floundering within a vacuum.
All right, and what do you recommend someone read if they're new to the sorts of ideas we've been discussing today and the sorts of concepts we've been discussing?
Well, in terms of general economics, I would say Economics in One Lesson by Henry Hazlitt. It's a good introduction to kind of the good free market way of thinking. If they want to get specifically into money and banking, I would probably recommend What Has Government Done to Our Money by Murray Rothbard. Nice short little book. And The Mystery of Banking is another really good one. It goes into a little more depth into exactly what fractional reserve banking is, what the money multiplier is, the bits and pieces, the real nitty gritty of how the Federal Reserve does its monetary policy. It's another really good book.
All right, well, very good. So I want to remind everybody to go to wakeupcallpodcast.com/federal-reserve. That's the show notes page for this episode. And, of course, we'll link to mengercenter.org and to the Menger Center's Twitter account and Facebook page and all of the books that we just discussed. So wakeupcallpodcast.com/federal-reserve is the place to go for resources and links related to this episode. And I also want to encourage everybody to sign up for our email list while they're there so they can receive show updates, and to follow us on Twitter at WUC Podcast. And on that note, Paul Martin, thank you for being so generous with your time. There was so much to discuss, and I know I kept you over time, but this is such a critical issue. I wanted to make sure that we were as thorough and comprehensive as could be with this sort of time allotment. So thank you so much for joining me and for helping me go over the Federal Reserve and how it's structured and how it operates.
All right. I appreciate it. It was great to talk to you. Thank you.
All right. Well, thank you very much.
Thank you for listening to this episode of the Wake Up Call podcast.
If you would like to listen to more episodes, please subscribe, rate, and review the show on iTunes, or subscribe on Stitcher, and check out our website at wakeupcallpodcast.com.
There you will find show notes pages and comment sections dedicated to the show. You can also email us at contact@wakeupcallpodcast.com if you're interested in being interviewed for the show or have any other suggestions.
Thank you.